Hello, everybody. We are just going to wait a few minutes till more people can join, and then we'll get started on the webinar. So feel free to get cozy. If you guys are just joining us, we're just waiting for a few more people to hop on. Hope you all had a good holiday weekend. Please feel free to use the messaging system. Oh, hello, Teresa from Rockford. Beautiful. I'm from Wisconsin, so not too far. We're just going to wait a few minutes because we have people joining every couple seconds here. So we want to make sure that we can cover as much for everybody as we can. All right, let's see. I'm just doing some housekeeping here for logistics and technology. So thank you for your patience. Hey, Emily. Hey, Lewis. Hey, Natalia. Woohoo, and Natalie from Vegas. Nice. Just doing a little housekeeping tech work here for a second. So thank you. All right. It's 5 after, so I'm going to get started, and I know we're going to have other folks joining us here. Before we jump in, we are going to just go through a few housekeeping items, so just bear with me for that. We will try to make sure if there's any technology issues, you can message, and hopefully you can hear us all clearly. We will be recording this session. Yes, Travis, we will be recording this session to answer your question. And please just keep yourself on mute if you can. We will have a Q&A at the end of the session. And we definitely want it to be conversational today, and we want every loan fund participating to get as much out of this as they can. So we'll guide the conversation, and at the end, we will offer everybody some time to ask specific questions. And so it's going to be pretty straightforward. And the whole purpose of today, as you know, is right now is a fun time in the CDFI world. We've had a lot of increased visibility around what loan funds are doing and the great work that they, accomplish in every community that they serve. And in that has come, a large, I should say, changing and ever evolving opportunity for different types of capital, which has led, a lot of organizations to think through how do they approach capitalization? What are the considerations to keep in mind when you're evaluating the sources of capital, cost, restrictions, compliance, all of those things? What are the different benefits and challenges associated with working with those different capital sources? and really importantly too, what are the investor trends that we're seeing in the marketplace? And so to help us with this conversation, I'm really excited because we have some really great organizations today to share that information. And for those of you that I don't know I recognize a lot of your names. My name is Stacy Zielinski, and I'm the Community Development Director at CDFI, at C-Note, sorry. I have experience in the CDFI world in that I've been a borrower, a practitioner, a consultant, and now I have the pleasure of helping CDFIs find capital to support all their operations. And joining me today, I have Joshua Brackett from ACE, and I'll go through quick bios in a second, Paul Quintero from Ascendance, and Kevin Mcgann from Sierra Club Foundation. So with that, I'm going to go into our bios and we're going to jump right into this conversation. So like I said, feel free to put in comments and we will get to those questions as best we can. My first CDFI that I'm going to announce is and has been a borrower of C-Note for quite a while, ACE, Joshua Brackett. And as a graduate of Berry College with a BS in Business Administration and Community Bankers Association Consumer Lending School, he served in banking with experience as a loan officer, collector, auditor, financial analyst, and finance manager with community banks. He was exposed to the needs of small business ownership at a young age, given his family's management of a small business in the area that he grew up in. And 9 years ago, he transitioned to become the Chief Financial Officer of Access to Capital for Entrepreneurs. And as Chief Financial Officer, Joshua oversees finance, accounting, compliance, all the fun stuff. He has grown ACE's assets from 7 to over 54 million in assets. He's helped them become a nationally accredited and organization and successfully secured debt capital from Goldman Sachs, Bank of America, Wells Fargo, PNC, and Hamilton State Bank, and many, many others. Since 2000, ACE has supported more than 1,000 borrowers and many other amazing statistics that we can share with you. And so we're excited to have Joshua with us today. In addition to that, we have Paul Quintero, who is a close friend of C-Note, and we are excited to have you here as well. Just like Joshua, Paul's experience is stemmed in his mom's experience running a small business, and she had an in-home child-based daycare, which really, I think, combined with his passion is what brings us here today in really understanding what do small businesses need to support and become successful and grow. Paul became the Chief Executive Officer of Ascendance in 2011 after serving as the CFO since 2007. And during his time there, he has done many incredible things, including the recent rebranding of the organization. Many of you might know of Acción East. Now it is referred to as Ascendance because their idea of helping everyone ascend financially is really the end goal and the mission of many CDFIs. He worked through and fully restored the financial position of the organization after the 2008 recession. He's expanded the footprint from New York to the entire country and has integrated successfully technology platforms, lending and fundraising operations, and has really helped develop their core culture and value-driven system internally. And prior to his work, he worked at Ascendance. He was a CPA, spent 7 years as an investment banker on Wall Street, and 4 years in a local redevelopment agency focused on the revitalization of Harlem and Upper Manhattan. And so we have both of these great organizations and people to share with us their take on finances. And I'm going to wait to give Kevin's bio till a little bit later, but we're going to jump right into what everyone is waiting for. And so Joshua and Paul, thank you so much for joining us today. And I promise we'll get through as much as we can. And I want you to give us the down and dirty so that we can make this as valuable for everyone joining us as we can. So I'm going to really frame this conversation around 3 buckets of capital that CDFIs have to worry about. When you think about raising funds, you think about it in terms of operations, loan loss reserve, and lending capital. And oftentimes, the hope of a CDFI is that you can find combinations of those three types of capital from different sources. Sometimes you can get them all from one source, sometimes you can't. And so with that framework in mind, I would love to start this off, Joshua, with you and just saying, generally, how do you approach capitalization, keeping in mind those three buckets of capital?
Thank you, Stacy. So just trying to keep in mind those three buckets and looking at especially how we're capitalized and coming into lending environment, being able to bring in loan capital to continue growing the organization, making the loans for the businesses, supporting our operations for the gap that is the nonprofit side where our earnings aren't covering it in the operating capital, and then the reserves against the risk that's in those portfolios is the loan loss reserve capital. So when we look at that, we look at what is our capital programs, what are our lending programs. So we participate with some of the federal programs which require loan loss reserve capital. So approaching a funder to say, hey, you can help us leverage additional lending in the market. We can utilize this program through loan loss reserve capital grants that come in to help us pull down federal sources. If that's not of interest, then going into lending capital, you can be part of our capital stack, giving us that needed capital to put out there for the small businesses. And then being able to talk about how to do the operating. We have some partners that will do all three to your earlier statement. And when we can find a partner that can couple the two together, you can talk about how their capital gets leveraged across the organization and can reach all the different impacts that we're able to do throughout our portfolio. If that funder is not interested in that and is only looking at, the principal and what are we doing from a jobs or a demographic or geographic location, then we can talk to them about how they can deepen their investments with us through just the lending side of the portfolio.
Oh, I'm sorry, I don't think my speaker was working. Paul, I want to throw that same question to you. Generally, in your approach to capital and looking at those three buckets, can you share with us your philosophy?
Yeah, so not a lot to add to what Josh laid out. I thought that was great. Maybe just, and I think this will vary by organization, but for us, we haven't done a lot on the loan loss reserve side per se. The way we've thought about that is that's sort of embedded in the risk that we take. And so the way we think about it is, what's the risk that we're trying to manage to? Or what's the loss that you're trying to manage to? And we start there because from that, we then say, okay, well, then what interest rates do we need to apply to cover that loss or expected loss, as well as the borrowing costs, which can vary by different lenders, so that, let's just call it, the money costs of what we do are covered. And so we haven't necessarily relied or used loan loss guarantees really much. What we focus instead is saying we have to manage our portfolio to a certain level of quality. Otherwise, it all sort of falls apart. On the operating side, what we try to emphasize is money doesn't move itself. So it's always helpful to get capital, yes, and we needed it, yes, and we deploy it, but only when you have the other parts of the organization in a position to deploy that capital. And so I look at what I'll call operating funds as the way that we sustain and grow and actually implement the mission. And I look at capital really as the dollars that get lent out to borrowers. So again, not a big difference from what Josh had described, but we don't necessarily look at the loan loss reserve as much. We just embed that in the rates, and then manage, our performance accordingly.
Thank you. Yeah, I think that's a really important point to make, to building that in to the total cost of capital that you're deploying. And I think that's a great opportunity to transition to when you guys are looking at the sources of capital and the even just from a self-sufficiency standpoint, what important characteristics are you looking at and keeping in mind when you look at the total cost and evaluating the cost of potential funding sources? And I'll throw it to whoever would like to go first.
I guess, go ahead, Josh.
When you're looking at the cost of capital, you've got the component of what does it cost to put the loan out on the street. Then you've got the cost of what does it cost to get the money to be able to put it out on the street. So your cost of funds coming in, where does that leave you? How much does it cost from a personnel time, from an operating perspective to put it out there? What is the risk, as Paul was talking about, that we're willing to take on, and how does that translate down to an individual loan? So the cost of capital can take many different pieces of that equation. When we're looking at capitalization as a whole on our organization, really the first focus is kind of looking at how is that stack blended, so that I can offer the most flexible option to my end borrower, which may have different risk profiles, may have different cost profiles based on the product that we're offering and what's going on. So really looking at it from how can I get a low interest cost of funds coming in? Well, how can I get a longer term so that my blend matches what I'm putting it out at? And just trying to be able to balance the organization as a whole from that earnings perspective to ensure that the software cost or your personnel costs that are going into making those loans, as well as the risk cost, can be then baked in a little bit further down the road as you initially talk about it and look at it.
And I think, Josh brought up the duration point, which I think to us is the most critical one. But beyond that, I would say geography is another element. We don't call it financial cost, but I call it emission cost. And because everyone has a different geography, it's less attractive for us to have capital that's concentrated just in one area, unless that market is so big that we can really easily get those funds deployed. So oftentimes we have people that offer, hey, we have a little this, a little that. And it's just not, again, going back to the people side, if we don't have a natural way to deploy that. So I would say there's a mission opportunity cost that we think about, because geography, place does matter, of course, and our ability to deploy matters. And if we get capital that's not aligned geographically, I think that's kind of problematic. Another element that isn't necessarily a financial cost, but I would think a business continuity consideration are the covenants. So once you have the duration right, so it matches your loans, once you have the geography right, so it matches your mission, how complementary, do those covenants fit into your existing lender base? Because to the extent that they're incongruent, that's an administrative pain and potentially a financial risk, right? So that is a huge cost if for some reason something's out of kilter, and that could trigger cross default, etc. So we're always thinking about how to harmonize covenants so that everyone's equally protected. We don't have any extraneous or extra burdens that we don't normally have to deal with, in order to make sure that the capital flows fulfill the impact that they're trying to create.
Yeah, I think, Paul, and you bring up a lot of good points around other restrictions, right? In addition to that capital cost, there's other things that you mentioned, the mission cost and those other restrictions that can make it hard to operate, to serve your community the best. Do you, in today's world, I think it's, much different than it has been probably over the last couple of years. Have you guys learned any lessons over the last year, and have you made any adjustments to potentially the cost of capital that you're willing to take when you have to look at those other restrictive considerations like compliance, like geography? Anything you can offer there?
Well, I'll just jump in that I don't know in terms of a cost that we have something necessarily that pops out because of the pandemic. I believe one thing that has shifted fundamentally, and this is, we know it's temporary, but grants wasn't a thing, really. Everyone asked for grants, and I think that everyone could probably say with confidence, really, there aren't that many grants out there for you. Not true in the last 18 to 24 months. And I think what that has done is a little bit of a substitution effect, where it's about grant programs that can help people revive because we had a total stoppage. So I think that's been very impactful. And as it relates to rates, has absolutely compressed expectations by borrowers as to what they should borrow at. So if it's not free, then it better be very low single digits. That isn't the reality that we had prior to the pandemic. So I think that that's something that has definitely shifted. Has that affected how we raise capital? Not necessarily. Has that affected how we can use capital? Absolutely. And we have been, and I think all organizations have been, in sort of a grant-making mode in the last 18 to 24 months in a way that I don't think any of us had really ever really seen. So that's the biggest shift that I've seen, and how we exit that is sort of a question mark.
I think one of the things that shifted, to add to what Paul's saying, is that the risk profile, how we look at that, both the compression of the interest rate has shifted how we're able to use that flexible capital, but also having more unknown in the risk profile. As those grant programs and subsidy programs are expiring, what is it doing to the true earnings of the businesses we're serving? And how are they going to be able to recover and recuperate that cost that has been being subsidized? That's still an unknown factor. We've experienced some of it as some of the programs have expired over the last 6 to 8 months, but with some still going and reaching expiration this quarter, it's still got some unknown factors. So one of the things we've been able to do and shift is to look at what kinds of flexibility do we have within our capital structure, what kinds of grant support from funders may subsidize some of those credit enhancements. With us having a compressed interest rate, looking at how does the organization continue to fund putting out a higher volume of loans, and how do we subsidize it with either reserve capital and or operating capital to help ease that burden, because our cost of putting it out there didn't go down. If anything, has gone up because we've increased the number of loans we're putting out on the street. So how do we get a better technology to make it more efficient? How do we add more staff and keep subsidizing that with that compression in the market and the higher risk? So one of the things we've been able to do is really talk about how to take a funder and marry those credit enhancements supported through subsidy and grants with our regular lending capital stacks to make that flexibility more present.
Yeah, that makes a lot of sense. And I know, we've had the opportunity at CNO to marry some of those grant funds with our Wisdom Fund program. And that was, very successful and helpful for a lot of the institutions that were able to take part in that and support those entrepreneurs and cover some of those costs that otherwise, may have been decreasing, the income that's coming into the CDFIs. So great point. I want to take a minute now to talk about some of those funders and investors, and I'm going to transition over to Kevin. Kevin Mcgann is the Chief Financial Officer of the Sierra Club Foundation, and he became so in July of 2019. He's responsible for all of the foundation's fiscal operations. And most recently, he was the Senior Director of Finance of the Energy Foundation in San Francisco for 6 years. And at that time was responsible for the oversight of all those financial activities throughout the US as well as Beijing. He's been working in the nonprofit finance sector since his move to the Bay Area, and has experience both with large foundations and community-based nonprofit financial institutions, nonprofit organizations, apologies. And so we're excited to have him here because the Sierra Club Foundation has also been, a huge supporter of CNOTE. And I think it's really important for us to understand what are foundations looking for today? And, again, things have shifted over the last year, but I think it's important for us to understand what can we do, and what can you do as CDFIs to really understand where you can secure other capital, in the marketplace, aside from those traditional routes that you may have been used to. Thank you so much for joining us today. I think the big question that we would love to have you answer is, what does Sierra Club find most appealing about supporting the CDFI industry?
Sure. Thanks, Stacy. For starters, foundations for the last 5 years or so have really started to take a deeper dive on where they can have greater impact with their investment portfolios, community impact, social impact, mission-related impacts. There's really been that shift to the point where obviously foundations still need to generate market rate returns to keep their operations flowing. But there has been a shift in wanting to see how can we do that and also have greater social and community impact as well. One of the trickier places to find that is actually in your cash. What am I going to do short terms with that? And the model that C-Note has built to work with CDFIs all over the country has actually allowed us to achieve some of that. So we had a rather unique situation when we started out back in 2018 with our initial $1 million investment with C-Note, where we were able to align with 5 different CDFIs around the nation that were part of the Sierra Club's Ready for 100 campaign, which are these metropolitan areas shifting to 100% renewable energy. So C-Note was able to partner with us to go into 5 of the communities that were in the Ready for 100 campaign, so that we could not only focus on the work that the Sierra Club program staff was doing on the ground in terms of that effort, but also support the greater community through investing directly in those CDFIs. So that's been great for us. We've seen some of the impact reporting as it ties back to job creation and affordable housing, particularly capital accessibility for BIPOC businesses. So our mission, obviously, we act as the fiscal sponsor for all of the Sierra Club's charitable work. So we don't touch any of the lobbying or political work. We strictly do the charitable side of things. And this has been a great fit for us. It really has. It's not a perfect bullseye in terms of the mission and the work that we do, but we've began to expand that view, I think, as a lot of foundations have as well, in that you've got to take in the greater community good if you're going to get your mission accomplished.
No, great point. And Kevin, I was going to ask a question that it looks like one of our attendees has asked as well, is how are you, as a foundation, evaluating, the impacts that you're interested in, and what is your focus on those investments?
That's still part of the journey that we're on. We're expecting to see that from a consultant we're working on who's building out an impact measurement tool for us as we speak. We have talked to a couple of firms who offer these directly. They've got the software for it. So we're talking to folks about that as well. And then we are looking for things that fall into that nexus of climate solutions and climate justice.
Okay.
And there aren't as many out there as one would think at this point, but they're popping up left and right.
Yeah, no, that makes sense. And can you maybe speak to, and maybe this is part of what you guys are working on at the moment, but is there a lean towards PRIs versus loan loss reserve versus, different types of grants? Are there specific types of funding that you're looking into?
On the impact side, we've actually created what we call our catalytic capital carve out. So we're going to invest $9 million over the next 3 years on BIPOC-led efforts that fall into that nexus of climate solutions and climate justice. It's a relatively small portion of our portfolio, but what we've learned over time through speaking with a lot of folks in the community is that the Sierra Club brand carries a lot of weight. So if we can get in on some of these investment opportunities early, it allows a lot of other foundations, a lot of other investors to feel a sense of security that there's already been some vetting on the environmental side, and kind of opens the door for them to have more confidence. We're also happy to share the due diligence we've done on the investments. So we think we have a greater opportunity to be catalytic through the sharing of our support through the brand than we do through the capital alone. I think you're muted.
Yeah, thank you. I keep clicking the wrong button. I apologize. Would you consider alignment around equity and inclusion when seeking capital? And we're wondering about how CDFIs can be really explicit with potential investors about, the priorities related to equity and other impact areas. Is there, room to share some insight on that?
Oh, is that a question for me?
Yes.
Yeah. Certainly
Sorry.
on the catalytic side, we require that as a focus in terms of what we're making the investments in. And that's become much more of a priority, over the events in America over the last year or two.
Mm-hmm.
Things have gone on. There's been a shift. Obviously, our mission is very specific around the conservation efforts and the environmental work. We're a much greater shift around the energy transition right now.
Okay.
But we certainly feel a huge emphasis on making sure that the investments we make, that equity inclusion there's a clear and stated commitment by whoever we're investing in to move that in the right direction. And that's taking a close look at how the leadership team has been built, how the actual investment team has been built, what the rest of the staff looks like, what the board looks like. And we've had to turn down some investments because people were doing good work, but they hadn't made that shift as a company themselves yet.
Yeah, I that's a wonderful point. I think to have everybody on the call here is it definitely it goes into the organizational structure and really demonstrating your commitment to that. So I appreciate you pointing that out.
Can I add one thing before I forget, because I don't want to slip my mind before we get to the end of the call, and that is, if you're a CDFI who hasn't yet worked on establishing a relationship with your local community foundation, I would really encourage it. I think there are some real opportunities. It's been years since I worked for the San Francisco Foundation. I've got a close relationship with some folks at the East Bay Community Foundation. I think there's a lot of potential for synergy there as not only investors, but partners. Absolutely.
Thank you for that. And I want everyone to just kind of think about that at the end, and we'll hopefully have some direct feedback on that and how you can do that towards the end of the call. That'll be something we'll discuss a little bit. Joshua and Paul, when you look at those relationships that you've been able to build on a local level with foundations, can you give us some insight onto how you started those relationships and how have you fostered them and helped them grow? And if not, what challenges have you had in trying to do that?
So we have relationships with several local foundations as well as national foundations that have come in through some of our we've got some that came in through place-based work. They saw the impacts we were making in some of the local communities and really wanted to help partner with us to make those impacts better. They were more focused on a very specific geography for a very specific target market. And then we have others that want to be a part of the overall diversified work we're doing within the varying target markets throughout our geography. And so being able to make sure that, one, those foundations are aligned with the impacts that our organization is trying to achieve, and making sure that there is a true alignment there and that we're not receiving funding that's going to kind of divert our resources to an area that we either are not positioned to serve well or are not in a place where that's the direction we want to go. And so being able to work that through with any new foundation or any new funder for that matter, because again, it doesn't have to be a foundation to help drive some of that market direction. And so making sure from the compliance, from the capital stack perspective, that all of that works to maintain flexibility with the markets we're trying to target and we're trying to serve. That's part of diversifying that capital stack, not only from a costing perspective, but from an impact perspective as well.
And would you say, Joshua, that it's been has it been received well when you talk about that needed flexibility, and has it changed? Because I know sometimes, there are some strict, requirements around compliance, but it does limit your flexibility. So have you navigated that in any ways, or any experiences you can share?
So usually the best way to navigate it is to show them what we already do well and how it aligns with what they're trying to achieve, so that you can reach a means to say, this is how we can help you achieve your mission within what we're already doing in our mission. And there is 80% of the time you can find an alignment, and there's enough flexibility on both sides that you can get there, but you've got to have a kind of focused effort on honoring both sides of that equation. What do you really need? What do you need to see? We have some that we do a lot within a certain area. And so by able to take on a smaller investment for a more focused area is not a burden to the organization, because we're already doing a good bit in that area. And so being able to loosen some of the reporting components, which helps them also maximize the impacts that they get to look at and see coming back to that community they're trying to invest in.
Wonderful. Paul, what would you add to that?
Yeah, I think the only thing to add would be to build a little bit on what Kevin was saying, which is that foundations, like any organization, are constantly evolving. And so beyond geography, beyond, let's say, the core mission, new things come up that become priorities. And then sometimes you have staff changes, and so you have new vision. And so I think it is about making sure that at every step of that journey, you're adding value, as Josh says, that you are aligned. And I would say that we tend to see tend to see some institutions that sort of continue sort of along a certain path pretty consistently, small changes, and others that strategically now want to have a bigger impact across a smaller footprint of CDFIs. So you have the give a little bit to everybody approach, and you have the we're really going to make an investment and go deeper. So we've seen both, and in those cases where it goes deeper, I think you have opportunities to really build some innovative things in terms of capacity and growth. So it's been interesting to see sort of the change. So same stimulus, right? Pandemic affects everyone, but then how people, and we're talking about foundations, how they respond sort of depends on the needs that they identify as core to their mission, B, strategically how they want to allocate funds, whether they want to be broader or more narrow. And then if they go narrow, which is something we've seen over time, then to what end? And that's where I think the things that Josh talked about in terms of you're probably 80% there, but there's always, there was that 20%. The 20% is 80% of the work. So that's where making bigger investments to really create that kind of capacity building or change, because we all have to change, really come to play. So we've seen all those things, but it's a relationship, and like everything else, you got to be there, you got to be engaged, you got to make sure that it's a win-win for everyone, and you don't take anything for granted, and you start again at the beginning of your year. So that's the life, that's the job. Absolutely.
And you guys obviously have been with the organizations for quite a while. Could you identify, is there any constant challenge that you've had to overcome consistently that you can share and tell us how you navigated that? I'll start with you, Paul, on this one.
Constant challenge with foundations, or I want to make sure I'm clear.
Just in general, any roadblocks or challenges you've had in raising capital, can be from foundations or any source.
Wow. I guess the only constant is there's no constant, right? Change with change is the change of state. So I would say I don't look so much external. I kind of look more internal. In this regard, that equipping the team to challenge themselves and to think things through and to reimagine, I think that's where it starts, because we are closer to what the work requires. We're closer to what's needed, but you can get, just like we talked about foundations within organizations. If you're not constantly asking why, why are we doing this? Why did you do it this way yesterday? And does it still make sense? You can become obsolete. And so I worry more about that challenge of not being complacent, of not taking things for granted, of not assuming things would be like they are, because what in the universe is, right? And so that's where we keep more vigilance. And what we have found is, as that's become more ubiquitous in terms of the thinking and approach, we've actually got to really substantive ideas that then when you have the conversation with foundations or others, they're like, yeah, that makes sense. And so it all resonates. But I guess we start on our side, and I think that's a constant. So I will say making sure that your teams are always reaching, always thinking, always looking, always observing. I think it starts there. And once you've identified a need, I haven't had too many foundations. No, you're wrong about that. Usually it's, oh, that we've been thinking about that too. I'm so glad that you've taken it a few steps. So it starts with us, and so that's the constant that I worry about the most. And then the rest, I think money finds opportunities and or challenges. And so as long as you can put your finger on it, as long as you can articulate what you're going to do differently, and if you're really substantive about things, I found that there's always support for substantive organizations or needs or issues.
Yes, absolutely. Joshua, what can you add to that?
So I think the biggest challenge is making sure you understand what one another are saying. It's whether you're talking to a bank or whether you're talking to a foundation, each one requires a different set of vocabulary, and what works with one doesn't always work with the other. And being able to communicate the message of what do you do as an organization, and how do you do that? Why? How do you achieve success and impacts within the markets that you're serving? And what are those markets? And then listening to what the other party has to say. What is the other funder? What is important to them? And then how do you line the two up? Being able to message that and communicate that successfully almost every time will lead to a successful relationship, because one of two things happens. You either determine immediately you're not a fit for one another and you part ways, but you're willing to then partner and make referrals to others that are a better fit, or you find a way to compromise, work together, and then you create a standing relationship. When you are working on trying to source capital for all three types, both your risk preservation capital, your operating capital, and your lending capital, overlapping those terms and those missions, those impacts, understanding what you do well and why you do it, and then being able to change the perspective of how you talk about it based on who you're talking to. A foundation that does not have bankers on their board or on their team can always understand why a loan works the way a loan does and how an impact comes from that. So having people on your team that diversify that message is equally important, so that you can say, yes, we are meeting an underserved need within our market, and this is how we do it through resources. This is how we can translate it to what you're interested in providing to that underserved market, and then define what that underserved looks like. And it means something different in every case. A CDFI has a target market. That's a starting place. You have a certified target market. It looks different for every one of us, every geography. Some of them overlap, some of them don't. Some of them are tighter, some of them are broader. But that's a starting place. And so being able to communicate that to a funder, regardless of what type of funder that is one of the most important challenges, because it can be easy in some regards, and in other regards, it's quite difficult. But understanding those perspectives and how to communicate that is probably the easiest and hardest thing to do as a CDFI.
Yeah, and that's a great point. And Kevin, I saw you shaking your head throughout that conversation. And I think it's important, especially for some of the newer CDFIs on the call too, to think through that as well as they start to establish their messaging, their external messaging, their internal messaging, and then, how are they going to approach that outreach? And Kevin, I'm wondering if you can give us any insight into what, how can CDFIs catch a foundation's attention? Are there any pointers in terms of messaging? Obviously that alignment of impact that you already mentioned and that Joshua just, spoke to. Are there any other pointers that you can offer in how they message to foundations?
I would just go back to my earlier comments in that I think where you want to start is as close to home as possible. And that being, most communities around America have some level of a community foundation, even if you're away from the major metropolitan areas, because then you can really begin to build a shared story about the work you're doing in the community that they're also clearly working on. And community foundations are going to have much broader missions than a foundation like the Sierra Club Foundation, which is a pretty narrowly focused mission, and our community is the entire United States. These local community foundations, they're going to, for the most part, be very attracted to the work you're doing locally. I mean, you're going to be able to tell stories about revitalizing businesses in the community. That's the exact same thing that they're doing. So starting closer to home, I think, is really what you want to do. And then building it out, where the opportunity is for some of the bigger national foundations where there's more money. But you also want to ride this wave that's going on right now, as I said, where pretty much every foundation is having a discussion about how they can have greater impact in their investments. And, this is a story to be told in working directly with CDFIs.
Absolutely. Yeah, I think, like you said, impact is that critical piece there. So appreciate that. So looking at, those different challenges and the external challenges, I'd like to shift now to some of the potential internal challenges that you face within the organization when securing capital. And so, for example, have you ever had to encounter or gone through where maybe you were bringing capital to the board for approval and maybe they didn't like that type of capital? Has there been any experience and insight that you can share in how that might have worked out for your organization? And Paul, I'll start with you.
Yes. So recently, and this was for a specific program related to the SBA, so the SBA Community Advantage. We were looking to raise capital specific for that effort. And in the discussions, and this is all about a lesson about trusting your gut, but in that discussion, we had some terms that I would call belt and suspenders. It was just too much. And I said as much. I said, really, we're getting this, but you want this, that. I go, well, all right, let's go for it. Let's see what happens. And it's probably the first time in a long time that the board kind of said, why are we doing this? Is this a good precedent? And did not vote to approve, some capital that had been committed, which I was sort of embarrassed that I even brought it up to the board because I should have just trusted my gut. But it's been a long time since something was sort of on the fence there. But it was a good reminder that things have to be structured right for everyone. It has to be win-win. And so, yes, that's an example of something that's happened where the terms don't fit. And it goes back to what Josh was saying earlier. You want not just duration, but, there's other terms, collateral in particular, that can become very problematic if they are incongruent with the rest of your capital structure. So doesn't happen often, but it can happen. And I think that's good governance.
Absolutely. Josh, is there any experience that you can reflect on?
So trying to grow and shift what your capital structure is, different sizes of the organization require different concessions from the organization in order to be able to grow. When we were much smaller, we were able to bring on debt in one collateral type position, more of a secured type position, to kind of obtain and build a trust factor with funders. And then trying to shift that profile to more of a unsecured or more flexible position requires some nice conversations and concessions on both sides, funder and organization. But it can be done, and we've been able to successfully do that. I would say one of the biggest challenges we had was bringing on a larger size funder who was towards the top of a concentration within our capital stack. They wanted to see some things for the growth of the organization that changed, that stretched our thinking internally on how do you approach this? How do we measure this? How do we have checks and balances in place? And so we went through a period with that particular funder that we wanted to be able to show and demonstrate to other funders we could attract this a larger funder. And we were willing to make the concessions for the betterment of the organization to grow. And so when you're talking about that, both internally with the staff level, with senior management level, as well as with the board and governance level, it requires some education internally on why would we want to do this? Why don't we want to do this? And for us, we made some significant changes. We had to change an auditing firm. We had to do some other things that most organizations are going to run from. We don't necessarily want to do that. That's too much. But for where we were and what we were trying to achieve, we didn't like it. And we did push back and negotiate some points, but we had to accept some others because we knew where it would be able to leverage the organization and take it. And looking back on it, I think we did the right thing. We made it all the way through. We had to educate our board all the way through that process in addition to our staff. And it was not necessarily easy to do, but was definitely something that and was the betterment of the organization as a whole. And so that's kind of what we were looking at.
That is, yeah, I think that's a really important point. And we have a couple questions related to this conversation, so I'm going to actually plug them in now. One of the questions related to what you were just saying, Joshua, was what were the organizational concessions that made such a difference to the large funder, if you can share?
So it was focused on some of the key covenants for the organization. It was making sure that we had an audit firm that was of a significant enough size to justify the growth of where our organization wanted to go. And so we had a much smaller auditor at the time, and they wanted to see a more well-rounded or larger firm that was doing audit work. That was a major consideration because there's a lot that goes into an audit of an organization. And so being able to understand that. Covenants around how you manage liquidity, how you manage your operating, things of that nature that caused us to look at how are we keeping that, how are we working our capital stack, how does it balance and work together, being able to make some concessions that had higher covenant rates than where we were really comfortable at the time, but pushed us to grow, focusing our efforts in a slightly different way, which in the end helped us manage our operational flow better. And so really looking at some of those things like liquidity covenants, net asset covenants, unrestricted net asset covenants, different elements that on an organization level may be easy to calculate and don't move quickly. But if you don't pay attention to them, they can also get it out of range faster than you think they can if you aren't paying attention to it in certain ways. And so making some of those concessions that caused the organization to fine tune its focus to make sure that those were not issues. And as we continued to grow, to really monitor how that works. Other types of covenants are, debt related covenants, secured funder versus unsecured funder, and collateral position within those covenants. Those are usually the ones that everybody's focused on and everybody's looking at. Mm-hmm. Many years ago, most of the CDFIs had to deal with the risk rating and allowance covenants versus what GAAP was doing versus what funders were making us do. That was one avenue that we all fought with. And I think that's mostly out under the bridge, so to speak. Mm-hmm. But that's another type of covenant that our funders tend to play with that can be concessions depending on how your organization is structured.
Yeah, absolutely. All really important considerations. Thank you for that. Paul, I'm going to jump back to you and we're going to start to wrap up this conversation. But one of the questions came in related to your last comments were, what were the terms in the proposal that the board was uncomfortable with? If you can share generally what that was.
Yeah, it goes to the secured notion that Josh was talking about. So we don't tend to use secured lending other than with the SBA. So everyone is basically unsecured. So this was different in that you have an institution that isn't the SBA that's looking for a secured loan. So that was kind of raising some eyebrows, but it was the notion that it wasn't even funding the full amount being funded. So for example, if there's a dollar loan done under the program, one would think, okay, great, that dollar is what you're looking to secure. But in fact, the way the facility worked is that I think it was funding 80% or 75% of that loan, but still wanted a dollar of collateral. So that's where you're like, well, wait a second. You give me a dollar, I can only use 75 against 75%. So I'm basically over collateralizing, each one of these commitments. That's really where I think the rub was in part, and then also in part the precedent that creating secured lending will have. If you do it with one, then the next institution will want the same thing, and then everyone is essentially you're kind of balkanizing your portfolio. That's a problem. So I think there were two different issues. One on the specific terms, it seemed like overreach, and two, the precedent. Do you really want to move in that direction? And so, given those two considerations, it made sense to just not enter or entertain it, and pass.
Right, and I think in some cases it's hard maybe for some institutions to to be able to, when you need capital, right, to evaluate that and make that hard decision. But at the end of the day, you don't want to restrict your actual operation and lending function by taking that capital. So I think that's a really good lesson. Kevin, I'm curious to know from your perspective, how, and I know you can't speak for everyone, but how does the foundation look at what they were just referring to in terms of, the covenants that they would expect if they were going to be investing, directly into CDFIs? If you can give us any insight into that.
Well, one of the things we're sensitive to is trying to approach this as a partner and not have it be a one-sided relationship. So we're certainly not asking people for the moon when we try to set these up. We're trying to keep things pretty simple and not overburden whoever it is we're working with. But it is something that we're dealing with as we build out this catalytic capital fund. Some of the investments we're making are in very new firms, firms with a handful of people working for them. So in terms of the due diligence we do, we want to make sure that we're thorough, but we want to make sure we don't overburden them at the same time. So it's a balancing act.
Absolutely. And if you could offer one piece of advice to all the CDFIs listening, if there was one thing that you would say, don't leave today without hearing this, what would it be in them preparing to approach some of those local foundations?
Just play up the synergy that you've got, that you're doing the same work, you're working in the same community, you're trying to achieve the same outcomes, and that the more resources there are out there in the community, the better.
Perfect. And Joshua and Paul, as we are going to soon move into the question and answers from other participants on today's call, one big question for you, in how you've seen everything evolve over the last year and a half now, and the new capital sources that have been coming, whether it be grants, whether it be banks, foundations, how do you see intermediaries like C-Note and others that are out there? How do you see them playing a role in the market, and what benefits do you see from starting relationships with intermediaries?
So I would say intermediaries can serve two primary purposes. Of one, helping to attract a funder that you don't really have a direct way to communicate with. And so being able to access funders that you would not otherwise be able to access. That's one critical role that an intermediary can serve. And another one is being able to tap funders that don't do direct investment or won't touch the size investment that you may want to do. They may want to do something much larger. Those are the two primary ways that all the intermediaries we've played with and worked with tend to be able to function the best and to work with.
I think I would just add that for us, the geographic flexibility that intermediaries can provide is a unique value add. The amount or size, well, we've had big loans from institutions that might not be so differentiated. The rates, that may not be so differentiated. The covenants, that may not be so differentiated. But geography, very, very, very much so. And because we're an organization that focuses on need, what we have found is that need can be right next door or 50 miles away. And just because of the way things are set up, 50 miles away may not qualify with the institution that's in your backyard, and therefore no capital. And that doesn't make any sense. Capital should go where it's needed. And so I think one of the biggest advantages of an intermediary is that geographical flexibility. And I'd say the second, depending on the intermediary, the knowledge about your field. And so Josh talked about having to communicate. Communication is a challenge. I should have mentioned that for all of us. But having to re-educate people or educate people, particularly banks that have not participated in the institutions of CDFIs, is a lot of work. And so intermediaries can accelerate that knowledge curve because they know who we are, they know how we function, they know what to look for. So there's a language, a vocabulary, a history that's already there. So those are the biggest advantages. It's quicker take up because you can have a conversation and get things done quickly. But B, for us, the geographical flexibility to put money where it's needed.
Perfect. And in addition to that flexibility, are there any other trends in the market that you can share with everyone listening and things that they should be on the lookout for as maybe new sources that you all have encountered or even just changes in the types of capital that you're getting that you can share? Paul,
I'm going to jump in on this one because I think the biggest that we have seen, and I have not seen this in my entire career, very excited and very worried that it goes away. But today, there are 18 states that I can think of that are benefiting from these special purpose vehicle structures that have been set up where either a philanthropic or public sector actor has sort of a first loss or guaranteed notion. Private investors, whether they be banks or funds or impact funds, provide the rest of the capital stack. These SPVs purchase loans that are originated by CDFIs like ourselves, which help with the liquidity, help with the credit risk. There's a certain economics that's set up that's not based on the interest rate because, as I said, there's a compression downward, but at least some servicing income because these loans can go out 5 years. And that is something that is dramatic in terms of the impact that it can create for CDFIs. It can create a revenue tail that we don't typically see pre-pandemic. And when you think about the breadth of what's been stood up, both Josh and I are part of a 15-state initiative called SOAR. We're participating in one in New York. We're participating in one in Washington State. And it's the same model. And every time what I've seen is CDFIs, because they don't have to go focusing time on raising capital, and they don't need a lot of their own capital, they're able to do what we really are meant to do, which is go find those folks with need, provide them with the support or capital or both, depending on the situation, and really create those transformations that we all seek. That hasn't happened ever, And I'm looking at that thinking, I hope that we don't take a step backwards because our field is being asked to step up. And if you're going to step up and try to scale your ambition of who you want to serve, you're also going to have to scale the capital that supports it. And this is one of those efforts that I think is not the end all. I don't believe there's ever a silver bullet, but boy, there's a lot of good things in this one that should be part of the opportunity set. And I've seen that it raises all CDFI boats. Organizations that had never done more than 100 loans a year are now doing multiples of that because of programs like this. And so that is something that is new. I think it's innovative. I hope it gets sustained, but right now are sort of 1-year efforts. And I think it's the most dramatic change that I've seen in the field in quite some time.
Absolutely.
Yes, being able to see the collaborative efforts of funders is definitely one of the most supportive and good changes we've seen here lately.
Yes, I agree. And I think, Paul, you hit the nail on the head with talking about CDFIs are really, in the limelight right now, and the expectations around the services that they provide in the communities is becoming noticed, which is good and bad, right? Because now you have to really find ways to communicate all the impacts, find the capital to support all that activity, and really, step up to the plate. So it's exciting, and it's also a lot of work, and hopefully the more visibility that, through your great work and through foundations like Sierra Club Foundation is going to help CDFIs, really deliver on that. And so it's exciting. We do have a few questions that we're going to go into. And so if there's anyone else on the call that has questions, please feel free to type those in. The first question is for either of you. Do either of you work on building individual investors? So in, direct investments through individuals or, other sources instead of going through an intermediary?
So we have, years ago, we had individuals or small institutions contribute, and we've just maintained. We haven't really taken that approach, in part because it can be very time intensive. We did explore individual giving, which is done obviously in the arts a lot, done in some other areas. And what we have found is it hasn't been quite the right fit, and we have raised significantly more resources with our traditional foundations, which have tended to be bank foundations, because the alignment has been there. So no, we haven't really pursued that. At a certain point, it can be very intensive on your team, but it might be the right solution early stage. So what's right at one stage may not necessarily mean it's wrong at a different one, but for where we're at now, it's a lot more meaningful to build on your either your banking foundation relationship because of the bank borrowing and the bank customers, and there's just a whole lot of alignment across a number of different areas than a one-off with an individual. We also have not seen the promise of individuals seeking the impact, and maybe, but that hasn't come to fruition in our experience yet.
Okay.
We have not been able to, or have not really cracked the nut on how to really approach and deal with an individual investor level. And so we've tried a couple of different times throughout, the last 10 years. But for the most part, unless they've approached us specifically, we have not had a lot of individual interest. And so our closest to that has been our work with C-Note and being able to refer them kind of to your product, and then by virtue allowing some investment back into CDFIs in that manner has kind of been the closest we've come to dealing with that individual aspect of the investor. So that's kind of how our experience has been limited with that.
Yeah, no, I think that it's a common, concern that is out there. It's how do you manage it? How do you find that right fit and make it worthwhile? And it's important to always investigate those relationships and try to drive as much capital as you can, but also so that it doesn't, take away from your mission and too much capacity. Another question that either of you can answer, why would you want to exit providing a grants program for your clients? And this particular organization said, we initiated forgivable loans for startup costs many years ago because of the need in communities.
Yeah, let me comment on that. I think it might have been a comment I was talking about the shift.
Yeah.
So it's not that forgivable loans or grants or even grant making is a bad thing. It's just that it's hard to sustain. So I look at things as sort of, I guess to use the baseball analogy, there's innings. So right now in a pandemic, yes, there's grants and yes, you can deploy them. But then after this inning, what happens next? And so I don't know that they're sustainable. That's one challenge. The second, but they're definitely needed. So we all pivoted to that. The second thing is that you need a revenue stream to support your organization. So the sustainability of a one-off grant is also very difficult. So I myself, is not that I'm against, if you have a way to create a sustained effort to grant money and support that grant making, that's terrific. I just don't know that for us, we see that as a long-term strategy as much as a near-term pivot, because the needs require it. And because of that, we're sort of cautious on pursuing short-term efforts. I'll call them almost one-time efforts. That worries me a lot, and so I try to avoid that when I can. And that was really the sentiment I was trying to express, that we know we need to get back to regular loan demand, regular businesses. But of course, if there's these programs, we will support them. We were part of PPP, like many CDFIs, and that's the right thing to do. But PPP is done. So now what? So I think that's the challenge. And just like you have to learn how to pivot into these things, it's important to learn how to pivot out. And I don't like putting too much emphasis on things that don't have some kind of sustainability.
Yeah, absolutely. That makes a lot of sense. This is for either of you, so I'm gonna hop over to you, Joshua. How do you measure impact? And obviously, one of the big challenges that I think many CDFIs have stated, and here in the chat, is funders always want some quantitative impact frameworks, right? And every CDFI does do it a little bit differently. So what are your best practices around that, and how do you do it?
So measuring impact's a tough one because everybody wants to do it a little bit differently, but understanding what the information you gather so that you can measure it appropriately and accurately, or as best as you can for the type of measurement it is. Some of the standard ones in our small business space is, job creation, measuring how do you characterize that, dollars deployed, revenue growth, those kind of things. Some of the more hotter topic ones that are harder to measure are more qualitative. And so some of that is just still trying to figure out how to do that. As we look at impact, it's, what's being served within certain target markets, within certain geographies. What's the job creation impact? Those are our standard measurements. And then trying to see, kind of how do you deal with the qualitative aspects within those measurements.
And I think the only thing I would add is one of the challenges we have is doing it longitudinally, because we tend to have sort of a moment in time where you're really working closely with the business owner. Business gets funded, or the loans provided for the business, and then of course you see it through repayment, but the interactions become a little less intense. Even if you follow up, they're never as intensive as when they were seeking the capital and you really had a lot of opportunity. So we are in the process of shifting how we monitor progression, and we're using data to do that. And we sort of call it in-house a credit monitor. So just like when you go to the hospital, they put something on your finger and something on wherever to monitor heart rate and to monitor, oxygen levels, etc. We're trying to do the same with our portfolio so that we can get a heartbeat every week or every month on what's going on, so we can be more proactive, and we can see changes over time. Because the point of our rebrand was to really help create upward mobility, and we don't feel we were good at tracking that. So we're in the midst of trying to get better on the longitudinal. We're using data to do it, to make it more real time, to make it more proactive than reactive, but more to come. So that's above and beyond the measure question. Yeah. How frequently you measure and who's doing it and how to do it in such a way that you can sustain it. We're right now on the cusp of that, and really trying to really become better at this.
Yep, and I'm just going to add to that as well, because as an impact investor aggregator, that we are, are always faced with that question. And we try to make sure that we're not, again, burdening the organizations, but the impact investors want to know and they want to have that data. Absolutely. And I think, Paul, that longitudinal piece is important, and really making sure that in however it's communicated, it aligns with their personal values or their corporate values. And I think we definitely have seen, that shift, happening more so over the last year, because I think people are more aware of what impacts they can actually put their money into. So I think it's positive, but it's definitely a challenge for organizations. And I'm going to wrap it up here. One of the questions that came in was actually, I think, something that I would like to answer, and that was, have you seen corporate interest pick up? Do you think CDFI funders are diversifying beyond philanthropic foundations and banks now? And so I'm going to answer the first part, and then we're going to end with Joshua and Paula and answering that second part. For us, we've definitely seen corporate investment interest pick up tremendously over the last year, hugely. And we've made a few announcements around that. We've had, PayPal, and we've had MasterCard, I think, are the biggest ones that people recognize. There's a lot of those mid-sized corporations that, as Kevin pointed out earlier, are going beyond their D&E practices internally, and they're moving into that, what can we do with our cash mentality? And so I definitely think, along the lines of what you were saying, Kevin, if there's local corporations that you can, tap into, absolutely look for those opportunities, because they are interested and they have the cash. And so if there's any way to make that connection and draw that, that impact alignment, absolutely. So Joshua and Paul, do you think that, CDFI funders you've noticed are diversifying beyond the philanthropic foundations and banks that you've had experience with, just in general?
We have seen an increase with some of the larger corporations, as you've mentioned, some of those that are more notable, coming through intermediaries and some others. But it's been exciting to see that side of the market starting to get into our industry space and be more familiar or asking more questions. And so hopefully that will continue.
Yeah, I would echo that. And I think that the corporations are doing it and trying to do it in a sort of systemic way. And so you see them plugging in, and I think rightfully, into umbrella entities like OFN and others, where you can channel an initiative across many CDFIs. So it goes back to what we were saying before. Collective challenges require collective response, and really doing it more than just a one-off. So if the question is, do we see more corporations involved in our field? The answer is absolutely yes. If the question is, do we see sort of corporations locally investing in us, as a substitution versus banks? Not so much. It can happen, but it tends to happen in a much more meaningful way when you have sort of a systemic investment, systemic effort made. But it's a very positive development. And going back to that grant question, some of the telephone companies, we're big investors in grant programs around the country. Who'd have thunk? So it is happening, and I think it's a welcome trend, and I think I hope it sticks. It used to be that corporations used to worry about the public and other stakeholders as part of their overall responsibilities. It wasn't just the bottom line. That's a relatively recent phenomenon of the last 30 years or so. So maybe things are coming back to that, and we'll see. But I'm hopeful. It's a positive sign, and I think in particular the systemic investments have been very positive.
I absolutely agree. Well, we want to thank everybody for joining our webinar today. And Eddie, thanks for this last comment. He said he recommends that everybody do a listening tour with other CDFIs if you can. As you can see, Paul and Joshua are very willing to share their experiences, and I think that is really critical in helping CDFIs that are emerging and even going through a growth phase to understand some of the nuances around planning and their capitalization stack. So thank you both so much for sharing. And Kevin, thank you so much for sharing the insight from the foundational perspective. We hope to do this again in the future and offer, CDFIs just some added conversation and intel around how can they serve their communities better. And so thank you all for participating. And thank you, Joshua, Kevin, and Paul, for sharing your knowledge with everybody. Have a great rest of your day.
Thanks,
Thank you,
all.
everyone. It's been a pleasure.
Bye.
Bye-bye.
Bye.